Welcome back everyone, this is Mo Investing and we keep things short and sweet, so let's jump straight in. Now, Mastercard operates a global payment network that processes transactions between cardholders, merchants and banks, and their main sources of revenue are the payment network itself and value-added services, which include things like data analytics, fraud detection tools, and cybersecurity services, as well as others. Now, if we take a quick look at their numbers, Mastercard's market cap sits at 438 billion. Their trailing 12-month PE is at 28. Their next 12-month PE is at 24, and their 2027 PE is at 21. Now, the PE ratios are on the lower end compared to their historical averages over the last 10 years, so this might indicate a good point to enter into Mastercard. But if we go on to operating margin, it's at almost 60% over here, 59.4%. They do offer a dividend that is growing, and it's at 0.66%. And then in terms of balance sheet, their cash is at 8.2 billion with a debt of 17 billion, which might seem high, but they do use debt as a tool rather than a crutch. So they do use it to buy back shares and pay their dividends as well. And then their stock price right now, it's May the 10th as of the recording of this video, and it's sitting at $495. In terms of strengths, Mastercard does have strong network effects in play, in the sense that more cardholders attracts more merchants and issuers, which in turn attracts more cardholders. They do also operate in a shared duopoly with Visa, so they are the main two players in the space, and it makes it very hard for competitors to penetrate the space. Now, they're also a very capital light or asset light business, spending only around 500 million in capex per year, while their revenue as of 2025 was 32 billion. So the spend in comparison to how much the business is actually bringing in is very low, making them a free cash flow machine. Now, if we look at the risks, they do face regulatory pricing pressure, as the duopoly with Visa does attract regulatory scrutiny, and they do have open cases in major markets such as the US and the UK, and that could affect them in terms of the fees that they do charge on the processing in their network. The geopolitical exposure is also a risk, so anything that does cause consumer spend to go down could affect their revenue. They also face risks from stablecoin and crypto if that does scale without their involvement, but they did announce an agreement to acquire BVNK, which is a leader in stablecoin infrastructure, so they're already planning on diversifying into that space and capturing market share there. Moving on to their Q1 2026 report, so their net revenue came in at 8.4 billion, an increase of 16% over the same quarter last year. Their diluted EPS came in at $4.35, up 21% over the same quarter last year. Operating margin was up to 58.4% from 57.2%. Total operating expenses increased 13%, and payment network revenue increased 12%, while value-added services net revenue increased 22%. So solid first quarter for 2026. And in terms of outlook for 2026, they do say that their net revenue, they expect it to be in the high end of low double digits to low teens, and their operating expenses to be in the high end of single digits. Moving on to valuation, we'll use the average analyst estimate for EPS. So on average, analysts expect EPS to come in about $33 in 2030. So if we do use a CAGR calculator, that comes to about 15% year-on-year growth on EPS, and that would be around where I'd put it as well. So if we do plug that into our DCF calculator, so we'll go with 15% EPS growth rate and an appropriate multiple of 25, we could see that the share price by 2031 could come to around $900, which would be pretty decent growth from here, and this would honestly be my base case for Mastercard. If I was to give Mastercard a rating, I'd give it a rating of 5. I think it's a high quality business with relatively predictable revenue and a free cash flow machine as well. In terms of verdict, I'd say if you own Mastercard, it's a definite hold, and if you don't, I'd give it a buy. If you want to own a high quality business that fits the bill of a high quality business at a fair price, then I don't think you can go wrong here. However, I would like this one at a steeper discount, so if there is any major dips, I would be a buyer. And that would be it for the video. Thank you for watching, and I'll catch you in the next one.